September 15, 2008. Lehman Brothers, one of the most venerable names on Wall Street, files for bankruptcy. It's the largest bankruptcy in US history, and when Lehman falls, panic spreads across the global economy. It's the moment when the financial crisis reaches its terrifying climax. But how did such a powerful institution implode? Why did Lehman Brothers fall? To understand why Lehman collapsed, we have to go back to the beginning. Lehman Brothers was founded in 1850 by four German-American brothers, Henry, Cotton, Jacob and Philetus. They started out as a small cotton trading business, serving the textile industries in New England. Over the next century and a half, Lehman would grow into one of the most powerful investment banks on Wall Street. For much of its history, Lehman was known for helping finance entire industries. They took companies public through IPOs, advised on mergers and acquisitions, and helped governments issue bonds. In short, they were masters of traditional Wall Street deal-making. But starting in the 1990s, Lehman's risk-taking would lead them in a new direction. Under CEO Richard Fall, Lehman went on an aggressive expansion, moving beyond traditional banking to invest heavily in mortgage-backed securities. By the mid-2000s, these investments made up half of their portfolio. In other words, Lehman was betting big on housing. Now, mortgage-backed securities are exactly what they sound like. Instead of lending money to people to buy homes, banks and investment banks like Lehman would bundle those mortgages together and sell shares of the debt to investors. This allows them to spread the risk around and make more money by charging higher interest rates to home buyers. So everyone wins, right? Well, in a normal market, yes. But the housing market was anything but normal. By investing so heavily in subprime loans to people with poor credit, Lehman was able to generate huge profits during the housing boom. As housing prices climbed higher and higher, the value of their mortgage-backed securities also increased. Lehman executives boasted publicly about their brilliant new strategy and the stock price hit record highs. But behind this success was a ticking time bomb. You see, those mortgage-backed securities that made Lehman so much money look safe and secure, but they were actually built on shaky ground. Literally 40% of the mortgages in some of Lehman's funds were subprime loans to people who couldn't really afford to pay them back. And as housing prices began to fall in 2006, those subprime borrowers started defaulting on their loans at a rising rate. Suddenly, those mortgage-backed securities that were supposed to be safe investments became toxic waste. In 2007 and 2008, Lehman started taking huge write-downs on their bad investments. But even after billions of dollars in losses, executives downplayed the seriousness of the situation. Meanwhile, investors began losing trust in Lehman's leadership. In September of 2008, Lehman's stock plummeted 90%, and they desperately tried to raise capital to stay afloat. Rumors swirled that Lehman was on the verge of collapse. First, they tried to get Korean investors to buy a stake in the company. When that fell through, they asked Bank of America to buy them out. But that deal also collapsed at the last minute. Unlike Bear Stearns and AIG, who had imploded earlier that year, Lehman received no government bailout. With no buyers and no new capital, the writing was on the wall. On September 15, 2008, Lehman Brothers filed for bankruptcy under Chapter 11 with more than $600 billion in assets. This was the biggest bankruptcy in US history, twice the size of the next biggest, WorldCom. Shockwaves immediately spread across the globe. Markets crashed, credit froze, and the bankruptcy process began. Lehman's collapse didn't just mark the end of one investment bank. It was the tipping point of the entire 2008 global financial crisis. In the wake of the bankruptcy, millions of people lost their jobs, their homes and their life savings during the Great Recession that followed. Governments around the world launched massive bailouts and stimulus packages to try to stabilize the markets. And sweeping reforms like the Dodd-Frank Act were passed to try to regulate banks and prevent another collapse like the one that had just happened. In the end, Lehman Brothers became the ultimate symbol of Wall Street greed, over-leverage, and outright failure of oversight. But as we look back today, perhaps the most important lesson from Lehman that sometimes even the titans of industry can fall. No institution is too big to fail, and hubris and greed can bring even the greatest companies crashing down.